Hello, I Anand Jain from Hanumangarh, Rajasthan welcomes you to your favorite Shridevi Classes YouTube channel where we inculcate interest and confidence in science, engineering and management subjects. Today in our playlist of project management and entrepreneurship, we'll understand all direct tax which are functional in India, and we'll learn individual income tax, corporate tax, capital gain tax and security transaction tax. We'll understand how these tax are levied and amount are collected by union government, and the same amount is used for all development and welfare schemes of both central government and state government. So let's understand the direct tax in India. In this learning video, we'll understand all four direct tax applicable in India, that is individual income tax, corporate tax, capital gain tax and securities transaction tax. Like all other direct tax, incidence and impact of income tax fall on the same person, so it is called direct tax. Direct tax is levied and recovered directly from excise by the government. Personal income tax is one primary direct tax which is levied on the earning or income gained by individuals or HUFs, that is Hindu undivided families, small companies or firms or other entities. So directly on earning or income gained, direct individual income tax is levied by government. Throughout India, only the central government has the authority to levy and collect income tax. Income tax is governed by the Income Tax Act of year 1961 and it is administered in India by Centre Board of Direct Tax. This CBDT department works under the Department of Revenue of Ministry of Finance, Government of India. However, all income tax is collected by central government, but central government can share a portion of the income tax collected with all state governments through a mechanism which is designed by Finance Commission, and as per recommendation of Finance Commission, grants in aid and other intergovernment transfers were made by the amount collected through income tax by central government to state governments. The provision of the Income Tax Act of 1961 extend to whole of the India, and this IT Act contains provisions for determination of taxable income. It determines the tax liabilities. That act also include procedure for assessments, appeals, penalties and if required prosecution for income tax related matters. And the same act also define power and duties of income tax authorities. All income of a person are classified under following five head. One is salary head, other one is income from house property. There may be profit and gains from business or professional activities. There may be some capital gains as income, and one can have income from other sources which are not covered in these four. Now, the gross total income of all these five heads is aggregate of income, and this income is calculated after making adjustment for set off or carry forward of losses, and then the total income so computed will have to be round off to the nearest multiple of 10 rupee. So in these five, salaries, income from house property, profit or gains of business or profession, capital gains and income of other sources are aggregated together and adjusted for losses and rounded off to the nearest multiple of 10 for tax calculations. In income tax terminology, assessment year means the period of 12 months that commence from 1st of April every year to 31st March of next year. Now in income tax calculation, income of previous year is assessed and is taxable in the immediately following assessment year. So for assessment year of 2024-25 for an assessee, income of previous year, that is 2023-24 is assessed. So income of previous year is assessed and taxable in immediate following assessment year. Now the rate of tax is applicable as specified by Annual Finance Act of that year, which is passed by Parliament when submitted by Minister of Finance. In India, the tax rate of individual income tax vary, and that based on income slab of taxpayer, and we'll discuss this in good detail in next slide. For lottery income, the flat tax rate is 30% and long-term capital gain is taxed at the rate of 20%, and short-term capital gain on listed share under section 111A are taxed at the rate of 15%. So these are rate of tax and definition of assessment year. As per new tax regime for all type of individuals, for income up to 2,50,000 there is no tax, and from income above 2,50,000 to 5 lakh there is 5% rate of tax on this additional amount, and if income exceed 5 lakh and up to 7,50,000 the additional income would be taxed at a rate of 10%, and for income above 7,50,000 up to 10 lakh the additional income would be taxed at the rate of 15%, and from 10 lakh to 12,50,000 rate of income tax to be levied and recovered is 20%, and for income above 12,50,000 up to 15 lakh the tax rate is 25%, and for all income above 15 lakh the tax rate charged would be 30%. In old tax regime, there are three categories. One is general citizen below 60 years, other is senior citizen 60 to 80 years of age, and the third category is super senior citizen above 80 years. For all three categories, there is no tax if income is up to 2,50,000. For senior and super senior citizens, this limit is respectively 3 lakh and 5 lakh. The rate of income tax is 5% for income exceeding 2,50,000 up to 5 lakh for normal citizen, and for senior citizen it is for income exceeding 3 lakh to 5 lakh. For all three category, income tax to be charged is 20% for all income above 5 lakh up to 10 lakh, and for all income above 10 lakh up to 15 lakh the rate of income tax to be charged is 30%, and for income above 15 lakh the rate of income tax to be levied and collected is 30%. So income tax got a progressive rate of interest, and person having higher amount of income would be charged at higher percentage of income tax. If gross total income exceed 50 lakhs, then 10% surcharge would be charged on payable tax, which is computed above and after rebate under section 87A, and same surcharge would become 15 and 25% if gross total income exceed 1 crore or 2 crore. And for all tax payable, health and education cess is also applicable on all assessee whatsoever their income, and this cess is at the rate of 4% on tax liability after surcharge. One important thing is income tax shall be deducted at source or should be paid in advance, and ignorance of this may liable to penalties. Now tax planning is a way to reduce tax liabilities by taking full advantages of provision provided by Income Tax Act through various exemptions, deductions, rebate and relief as per application of script and moral of law provided in Income Tax Act. One can avail various incentives, concessions, allowances, rebate and relief which are provided in the Income Tax Act. Various deductions and exemptions are available under different sections of Income Tax Act, and which are as follows. One will get deduction for investment in specific financial instruments such as PPF, Public Provident Fund, LIC, Life Insurance Corporation Investment, or ELSS, Equity Linked savings schemes or mutual funds under Section 80C. Under Section 80D, one will get deduction for health insurance premiums. The Section 24 of Income Tax Act provide deduction for home loan interest. Similarly, Section 80E provide deduction for interest which is paid on education loans. Similarly, Section 80 TTA provide deduction on interest income of saving accounts. In the year 2021, Finance Minister introduced Finance Act 2021 with a new income tax regime. This new regime streamline old tax rates and remove various exemptions and deductions which are prevailing in old tax regime that make it easier for taxpayer to understand and comply with tax laws. This can help to broaden the tax base and increase the revenue collection for the government. Now it is very crucial to stay updated with latest tax regulations and amendments which are introduced in the union budget each year. When finance bill is presented before parliament, taxpayer should consult with intelligent professional tax consultant or refer to official government sources of income tax for accurate and updated information on income tax of India. Corporate income tax, capital gain tax and security transaction tax are three other direct taxes in India which, along with personal income tax, play a significant role in the revenue generation for the union government. In fact, the contribution of corporate income tax is slightly more than personal income tax. The corporate income tax for financial year 23 is 10.04 lakh crore, whereas personal income tax, slightly less than corporate income tax, was 9.6 lakh crores. Now, the tax directly collected through these four direct tax are used for the both center and state government for its development projects, funding public services, for infrastructure development of railway, road, energy sector, airports, seaports, or for development of digital infrastructure, rural development, irrigation or agriculture support and other welfare schemes of the government. Corporate income tax is number one contributor among all direct taxes in government revenue, and its share is slightly higher than personal income tax. Corporate income tax is imposed on profit which is earned by companies which are registered in India, and this include domestic Indian companies, foreign companies registered in India or corporations. Now the tax rate for corporate income tax may vary based on the type of company, its turnover and other factors which are specified in Income Tax Act. Domestic companies are subjected to a flat corporate tax rate of 25%, though there are some special export promotion zone or specific industries which got some concession in this corporate tax rate, while foreign companies may have higher tax rate, which is for some companies 30% and for other 40% based on the treaties between Indian government and the home country of that foreign company. Now, a surcharge of 10% is also payable when total taxable income of a corporate exceed Indian rupee 10 million, and there also exists a health and education cess of 4% on effective total corporate income tax as surcharge. Capital gains tax is another type of direct tax. Capital gain tax is levied on the profit which is earned from the sale or transfer of capital assets such as land, building, house property, vehicles, or intellectual assets like patent, trademark, or some leasehold rights. Even machinery, jewelry, and stocks of share market, mutual funds, and valuable items are also treated in capital assets. Now, the tax rate for capital gain tax depends on the holding period of the asset, and accordingly, we have long-term capital gain, which is taxed at a rate of 10% on profit earned, from the sale or transfer of capital asset, or a short-term capital gain which is taxed at a rate of 15% on profit, and any asset which is held for more than 36 months is treated as long-term capital asset, and for land, building and house property this period is only 24 months, and beyond that any capital asset is treated as long-term capital asset. Different tax rates are applied to long-term capital gain and short-term capital gain with certain exemptions and deductions which are available and applicable under specific conditions, and one must understood all provision of capital gain to calculate this capital gain tax. Another direct tax is security transaction tax (STT), and this security transaction tax is tax levied on transaction of securities such as shares, bonds, debentures, derivative or equity oriented mutual funds in Indian stock market, and security transaction tax is payable by both buyer and seller of security, and it is collected by stock exchange on behalf of government, and when any security is transacted both buyer and seller pay security transaction tax, and that is collected by stock exchange and deposited in government revenue system. Earlier in Indian scenario, two other direct tax, one is dividend distribution tax and other one is wealth tax, also exist, but now they are abolished. Earlier, dividend distribution tax was levied on companies which are distributing dividends to shareholders, and nowadays this dividend distribution tax has been abolished in the Union Budget of 2020, and now dividends are taxable in the hands of shareholders as personal income. And wealth tax was abolished in year 2015, was a tax levied on net value of wealth belonging to individuals or Hindu undivided family exceeding a specific limit. However, we have abolished this wealth tax provision in year 2015. It is important to note that direct tax laws and regulations may change over time due to amendments in legislation or changes in government policies. Therefore, it is essential to refer the latest updates and consult with tax professionals for accurate information regarding currently applicable direct taxes in India, and one should submit tax return with proper consultation with tax professional so as to avoid penalties or any prosecutions. We hope this beautiful learning video has explained all four direct tax which are applicable in India. Now you can understand income tax with good detail, and we have also described corporate tax, capital gain tax and securities transaction tax. Our other learning video of the same playlist are equally useful, and you can use them in your study or also share them to your friends as referral for their studies. The same learning video is also available in Hindi language with HV marking in title. We hope your learning will improve by these academic work. Have a nice time. Happy learning. Thank you very much.